Right. I think we are recording. Right. Good morning. Hello. Welcome everyone to the 100th episode of the Stock Doctor podcast. I mean, at the same time, it is the third anniversary as well. I did tell you in my numerous build, I gave you a proper build up. Last episode, I told you that, we're going to build up to something special on the 100th episode. Trust me, I have been planning this for a while to give you the best experience possible. And I wanted to do something different. And I also wanted you guys, I'm sure you guys must have, after 99 episodes of hearing me talk, I'm sure you guys have probably bored out of your mind. So I wanted to do something special. I wanted to introduce you to an individual who I've been following a lot on LinkedIn, and something that I would really like you to also follow. Once I'm sure at the end of the show, you'll definitely follow this gentleman as well. But without further ado, it is my absolute pleasure to introduce and welcome Dr. Ryan Lemand to this 100th episode. Just to give you guys an introduction, sort of like a street cred. Dr. Lemand is a co-founder and CEO of Neovision Wealth Management. Lemand also has a PhD in financial econometrics from ENS France. He's a seasoned investment professional, a lot of experience as investment manager, and he's a former regulator as well. He's a wealth of experience in fixed income, credit, quantitative asset allocation, and risk management. And just to let you know, he's not just an investment manager, he's an extremely popular investment manager on LinkedIn. Like I said, I've been following, he's got over nearly 30,000 LinkedIn followers. I checked it, 29,566 is what it said. I'm sure by the end of the show, or hopefully it'll cross 30 and even beyond. So he's extremely popular on LinkedIn. His posts, and just to let you know, and you get an idea of this during the interview, that his posts are actually really refreshing, and they're very, very different from traditional media. So I've told you guys multiple times over the course of the show that, sometimes media, whoever comes into the seasoned investment professionals, experts, come in and give them the same line of thinking. If you want something different and if you want something the real truth, I would urge you guys to follow Dr. Lemand on LinkedIn. So Dr. Lemand, it is an absolute pleasure and honor to have you here on the special occasion of the show on the 100th episode and the third anniversary. Welcome to the Stock Doctor family.
Thank you very much. And first of all, congratulations to you on the 100th episode and 3-year mark. This is a milestone because that means you're growing, you're expanding. You're doing a great job. I think you have a lot of energy in putting the podcast. So I'm delighted and honored that you have invited me for this big milestone of your show. So thank you very much.
Thank you so much. Thank you so much. Right. I know time is of the essence, so we'll get straight to it. We'll get absolutely straight to it. And, you know this, you knew it even before we discussed, we had the briefing, you know what I would start into because of the series of LinkedIn posts I've seen, and that is the Fed. So I got to start off with the Fed. Obviously that's on everybody's minds right now. It's the latest latest addiction for investors. It's been the latest addiction for investors over the last few weeks at least. And so just wanted to tell you, right, we recently had the most anticipated Fed decision in probably about 20 years. I feel like since the financial crisis, I feel like this has been one of the most anticipated decisions. Prior to the meeting, you and I had a chat, and you did tell me that you were part of the 25 basis point cut camp. You gave me reason. It doesn't make any sense for the Fed to do 50, and then just keep cutting rates for the sake of it. So you were in the 25 basis point camp. And you told me that it doesn't make any sense for them to cut 50. Unfortunately, Jerome Powell and co did not listen to you or did not listen to it, and they went ahead and did the 50 basis point rate cut. So I am assuming, based on what we've heard, that you're clearly shocked about this decision. So my first question is essentially very straightforward. What's your take on the decision made by the Fed and the 50 basis point cut? Yeah.
So myself, like 90% of economists and CIOs have gotten this one wrong. The reason behind it is very simple, is that 50 basis points cuts as the first cut after a cycle of holding rates is extremely rare in the US. This has happened twice in history only. Mm-hmm. And in these two times, what followed were bone-crushing crisis in the United States.
Yeah.
The first one was in year 2000, and the second was in what it was in 2007, obviously.
Yeah.
So when the Fed starts with a 50 basis point cut, he's signaling there's something really serious happening in the economy, that there's something quite serious that is about to happen.
Yeah.
Okay. This is the message he would send us as
Yeah.
market participants.
Yeah.
Now, is it 100% the case? I'm not sure. One reason that I factor into this decision is related to the elections.
Mm-hmm.
So, as you know, President Trump does not want to renew for Chair Powell his chairmanship,
Correct.
and potentially a number of board members of the Fed as well.
Yes.
So, and we know that both candidates, Mrs. Kamala Harris and President Trump, they want interest rates lower for electoral reasons.
Exactly.
So the bet of Chair Powell and the board of the Fed is to reduce rates quickly, gain the favor of Mrs. Kamala Harris, and then potentially remain in office.
Okay.
So this is one explanation that I read actually and heard in the US media, which, it's plausible because the Fed, though it is an independent institution, but we know it's very much affected by US politics.
Yeah. So it actually brings me to a follow-up question. So basically, during the press conference, everybody was shocked with the 50 basis point rate cut. And when Chair Powell basically came in and gave his press conference, he basically said that, it's the reasoning is, it's not that the economy is bad. In fact, his exact words were, the economy seems to be in good shape. Do you think that's just smokescreen? Just to hide the reason.
Thank you for bringing this up.
Yeah.
I tell everyone, guys, you need to be history readers. My advice to everyone: history is cyclical. We as humans, we react the same way to events. So things happen again and again and again, and that's why we say history rhymes or history repeats itself, etc. Let's go back to 1999.
Yeah.
Just pre-dot-com bubble burst, right?
Yeah.
If you hear what was said back then by the chair of the Fed, unemployment is fine, the economy is fine, do not worry. Please go ahead. I posted on LinkedIn multiple quotes that were released back then.
Yeah.
2007, Chair Bernanke said exactly the same thing. He was even early in 2007 reassuring about the housing market, for God's sake. The housing market was literally collapsing, on fire in the US, and he was reassuring about the housing market. This is the role of the Federal Reserve. Yeah. Imagine a Federal Reserve that says, panic, women and children first. What's going to happen, right?
Yeah.
No policymaker and the Federal Reserve will do that. So you'll say, don't worry, everything's fine. Remember the Titanic. The music was still on the last month, okay? So this is the role of a policymaker, is to reassure as much as possible, because there's no need to add panic to an existing problem, okay?
Yeah.
So no, the US economy is not fine for multiple reasons, and I'm sure we're going to talk about them during the show.
Absolutely. I'm glad you brought up, history repeats itself, because I've told you guys already, I'm a huge fan of Dr. Lamand's LinkedIn post, and one such post actually caught my eye, the one you made on Wednesday, just ahead of the Fed's decision, just before the Fed's decision. And I'm going to read it out here. I don't want to misquote. I already misquoted once at the start. I don't want to do it again. So. The post was quite fascinating, and it basically said, last Wednesday, would have marked 420 consecutive days where the Fed held rates steady. The last time such a streak happened was way back in 2007, coincidentally on September 18th as well, and coincidentally when rates were at 5.25%. I mean, this is what caught my eye. It's some serious freak show, I would say. And at that time, back in 2007, the Fed had held the rates consecutively for a whopping 446 days. So you have 420 days in the current cycle, 446 days in 2007, and we all know what happened in 2007. You gave us a glimpse. So just as a follow-up to your comments made earlier, do you think, again, based on the decision made on Wednesday, the Fed is again behind the curve? And just as a follow-up, is soft landing everybody's favorite word, everybody's most elusive word? I mean, it's like Narnia. You could basically compare it to Narnia. Is soft landing once again going to be elusive? That's.
I just want to add one number. Yeah. So holding rates for a very long time. This happened twice in history, as you mentioned.
Yeah.
2007. pre the crisis, 446 days, and now 420 days.
Yes.
You know what's the third period? It's pre-year 2000 dot-com bubble, 232 days.
Okay.
And then we go down to much shorter periods. So what is happening in the US? What is happening? The US today is experiencing less and less the recessions and cyclicality of business cycles that we used to see in the United States.
Correct.
What is happening today with the fantastic, I'm being sarcastic, invention of quantitative easing? Now it is possible to suppress recessions. It's possible to suppress economic slowdowns. Okay? So this is what's happening in the United States, which I find extremely bad. People say, no, recessions are bad. They're absolutely not bad. Recessions are essential to an economy. And this is why the US economy was a very successful economy, because there were recessions, because there's business cycle cyclicality. So why are recessions important? Think of it this way. When a recession happens, weaker companies, they file for bankruptcy. They go out of business.
Correct.
Frauds, they get exposed. Remember 2008, if we didn't have a crisis, Bernie Madoff would not have been discovered.
Spot on, yes.
So today, if you look at the US listed companies, 25% of US listed companies are zombie companies. Zombie companies. And please look up what is the definition of a zombie company.
Yes.
Why are they surviving? Because of the quantitative easing, because of low interest rates, because of the accommodation. An economy that has companies that are too big to fail is no longer a capitalistic system. This is not capitalism. Capitalism is not having companies that are too big to fail. Capitalism is when the weak fails, is when the weak goes away and is replaced by something stronger and better. A recession makes an economy stronger, just like our body becomes stronger when we get sick, a flu or something. Our immunity gets incentivized. It's very similar to the economy. Last thing I'm going to say, we as humans, when do we invent? When do we create? When do we innovate? When we are faced with adversity, when we are faced with difficult headwinds, this is when we innovate. This is when we create. And this is when we become the magnificent human race that we are. So today what is happening is we're suppressing that. Okay. What's the invention? Is this an invention? Have you looked at the iPhone 16, which is similar to the iPhone 15, which is similar to the iPhone 14, etc.? We are not innovating and creating anymore. Remember when we were children, we used to look at the movies that show you the future, that in 2024, we will be traveling to Mars in a spaceship, and look at where we are. We celebrated just a couple of years ago, 2 billionaires flying just to the 200 kilometers into space and coming down. Are we celebrating this? In 1969, we went to the moon, for God's sake. Today, we're celebrating just going 200 kilometers into space. We are not innovating as humans like we used to do before. And AI is not innovation. We'll talk about that.
We'll talk about AI as well. No, but to be honest, there have been so basically there has been a counterpoint, just to bring a counterpoint to what you said. The talk of recession has started, when the yield curve inverted, right? Since the yield curve inverted, that was first time. And then recently, when the labor market dipped, we talked about the SAM rule, and that came into question as well. So much so, Claudia Sam had to come in and basically clarify what the rule was, and so on. The thing is, the talk of a recession in the US and the talk of a complete breakdown of the US economy has been going on for months on end. But do you think that it's going to be something that, do you think things have changed post-COVID? Because, like you said, quantitative easing, suppressing recession, but at the same time, the household wealth, and that was another post that you had posted as well on the US household wealth, had increased as well. Do you think the pandemic savings, even though they have dwindled, would probably get us to a point where the Fed can cut rates and again balance it out so that we avoid the whole idea of a recession? Do you think that's possible, or do you still think, like I said, like history repeats itself? Chair Pavel said, economy is in a good shape. 2 months later, we are in pandemonium. Do you see that happening?
Let's talk about the indicators you mentioned. We never get a recession when the curve is inverted. The recession comes after this inversion is over and there's a steepening of the curve. This is when the recession hits. The recession does not hit before we start cutting rates. It's usually after the Fed starts cutting rates by several months and sometimes a year. And we have seen this in history as well. Okay, so these are the small indicators. So the steepening of the yield curve is a self-fulfilling action that will eventually cause inflation because recession because longer rates have become very expensive. Now, why and how did the US manage to suppress recessions post-pandemic? It's usually using deficit fiscal spending, as we know. Deficit in the US is at absolute records. We're going to end the year with $36 trillion. The interest rate that the US government pays on its debt is as much as military spending. I mean, I don't know if people fathom how much this is huge, okay? So fiscal spending. How is it translating? So any economist would know when the government spends $1 into an economy, there's something called the multiplier effect, which you can look up on the internet. The multiplier effect means that each $1 government spends translates into $4 into the economy. So imagine how much it expands in the economy, which is a good thing. But not when the growth of the debt of a country exceeds economic growth. This means I, as a nation, I'm falling apart, basically. So this is exactly what is happening in the US, and this is unsustainable. The second translation of this, which is reflecting on the employment rate, which you mentioned. If you look at jobs, close to 40% of jobs created are government jobs, social services, etc. Okay, so if you look at the latest revisions that were made, which are very revealing, 819,000 private jobs were revised down, and 1,000 government jobs were revised up. So the net is the 819 we saw. Which means the US economy has created 818,000 less private jobs than forecasted, than numbers indicate, and 1,000 more government jobs. So which means that the jobs lost on the private sector have been compensated with government jobs. And this is why unemployment hasn't risen.
Actually, it's not even compensated, isn't it? You're still going down massive, and the government jobs is not even able to catch up, isn't it? It's a post I actually saw it on the morning today. The one you told me about the 819,000 jobs. But Dr. Lemand, actually, this is a great segue for me to go straight into the US debt. Because I think you talked about the deficit, and I think you've been an absolute very vocal proponent about why is no one talking about the debt. In fact, this is another, just to bring out another of your LinkedIn posts that you basically said, not just LinkedIn posts, you basically said about why is no one in mainstream media talking about it. And you're absolutely right. Like, you get an opinion piece here or there, you get one opinion piece here, Financial Times puts another opinion piece. Nobody's really talking about it in the front page. I actually read one of these opinion pieces on Wall Street Journal the other day, and the data is staggering. Like, according to the article, you have a national debt held by the US public at 28 trillion, as you mentioned, $28 trillion, 99% of the GDP. The 2024 budget deficit alone is nearly $2 trillion, which is 7% of GDP. And you have the Congressional Budget Office now projecting that by 2035, debt held by public is expected to top $50 trillion, which would be 122% of GDP, and an interest expense would be 1.7 trillion a year. Simple question, Dr. Lemand, why is no one caring about this? I mean, including the two presidential candidates who are both happy to keep raising it as part of their agendas. I mean, is it the confidence in the dollar? Is it the confidence in the US economy? Is it the fact that 2035 is too far away and people believe we would be in Mars by then? I don't know. What is that? I'm trying to rack my brains around it. Like, what do you think?
We as humans, whenever we're faced with a problem that we cannot solve, we just put it under the carpet. Just put it under the carpet. Forget about it. Okay. President Trump threatened nations who stop using US dollar. And I'm sure everyone has seen it.
It's true.
A presidential candidate and President Trump is known for being very, very transparent and honest in his opinions, which is a good thing.
Yeah.
But when a presidential candidate and an ex-president of the United States of America threatens countries if they stop using the dollar or reduce using the dollar, I mean, this tells you it's biting.
Yes.
It's hurting the US.
Very
all of the countries that are not using the US dollar anymore or using it less.
Yeah.
Okay. The US today, the only sustainable path it has is increasing debt and continue spending.
Yeah.
And this goes back to the point of innovation, because the US, in order for it to be an economic superpower, it needs to innovate, right? And this is what the US was. It was an innovation place.
Yeah.
Okay. It was products with manufacturing. Today it's services. It's all services.
Yes.
The Airbnb and I mean, this is not innovation. It is creating value. It is creating value. We're seeing these mammoth IPOs that jump and then go down. I mean, look at WeWork. Look at the creation of value and destruction. This is not innovation. This is not what the United States of America used to be. It used to be an innovating nation. Now, why was this working until a few years ago? Two reasons. One, it was possible to buy from China at prices that are very low. Okay, so China was manufacturing parts and the US was selling and assembling. So at very low prices. And this is why we've had low inflation for a very long time in the United States and the rest of the world for that matter. The second reason is that China was buying treasuries.
They were, yes.
Today, both are not happening anymore. Buying much less from China, and China is almost not buying treasuries anymore, which is problematic for the US. At the same time, you have the BRICS countries, for political reasons, let's just say it, I'm going to be very transparent about it. They are buying massive amounts of gold, absolutely record amounts of gold to back their currencies. So today, the rest of the world is faced with either collaborating with the BRICS, whose currencies are backed by gold, or the United States, where it's spiraling debt and no plan to reverse that. Because the day deficit spending is reversed or reduced, the US economy will come to a halt immediately. Because this $1 turning into $4 into the economy will be much less than before.
Yes, absolutely.
Unless the United States, and this is what I criticize the United States a lot because I want them to be better. I want them to go back to the model of manufacturing, of being a real economy, and not just a service economy, right? A manufacturer, okay? Is to innovate, and innovation will create economic growth, and economic growth will exceed the growth of debt, and then you come out of the problem.
Yes, exactly. Yeah. No, I think the biggest example of what you just said is Apple, right? It was supposed to child of innovation, and now it's focusing on the services business. And with its app store and so on, I mean, there's no new product that's coming out. I mean, the last one was the headsets with
the Vision Pro. Where is it? Where's the Vision Pro?
No, nobody's hearing about it. Nobody's talking about it. Like it's crazy how I think that just kind of gives you the idea of exactly how you. I mean, I think Apple summarizes the point that you should post child of innovation. Also switching to services is a massive deal. And then we got to talk about the robo taxis and autonomous vehicles, where US talks a lot about it and China is already building it, right? So you've got these massive differences in it. So Dr. Lemand, just to like, it is very clear to me that you're very negative about the US economy, rightfully so. You've laid out the points very, very clearly. So then, if an investor were to, for your clients, and if a potential investor were to come and ask you, like, if you're so negative about the US economy, where do you see the opportunity? Is it the emerging markets?
So we've been doing it for 2 years. We had TINA before. Remember when we had TINA? There is no alternative. Well, there is an alternative today. Okay, these alternatives are Japan, used to be Brazil, India. India is China 15 years ago. Okay, I mean it's fantastic what's happening in India. Okay, you have the Gulf Cooperation countries where I live right now: the UAE, Saudi Arabia, Oman, Qatar, Kuwait, etc. So there are opportunities out there. Then you have gold. Gold is here to stay because it is being bought massively, because the world is realizing, because of the geopolitical stress, etc., etc. Okay, agricultural investments. These bring you dividends. These are stable. This is real economy. This is growth.
Yeah.
This is a straight line.
Yeah.
We have never seen agricultural investments actually go down in value. This is not real estate. Real estate is cyclical. Agricultural is not.
Yeah.
Okay. So many investments that can be done out there. Now, regarding the US, we are a top-down investor.
Yeah.
So we look at macro and then we drill down to stock picking. In the US, we're doing it in reverse. We're doing bottom up.
Bottom up, yeah.
Because if we start top down, we don't invest. Okay.
It's very, yeah, that's been obvious, yeah.
Because the image is not pretty. Okay. So we do stock picking. We're very selective. We're very opportunistic. So look at the Russell 2000 companies.
Yeah.
Within the Russell 2000 companies, where you have the small to medium size companies, you have many of them family owned or family driven type of companies that are paying dividends, that are generating earnings, that are growing, that are very low debt to equity with a sustainable business model. These are fantastic companies to buy, even though their price is not going up, but we buy them for their stability and for their dividend distribution and for the diversification that we accomplish with them.
Okay, all right.
2 years ago, 1.5 years ago, we recommended the 2-year US government bonds.
Yeah.
Okay, and it's public, it's out there.
Yeah.
Look at what the 2-year has done with the steepening. When the Fed actually reduces rates, the front end of the curve is pressed down.
Yeah.
So you actually make money. So the 2-year was paying you 5%, which is fantastic. Yeah. And now it has rallied, which is better. So the whole curve has went down, but especially on the front end. So there are opportunities in the United States to invest in. And the third vertical that we do invest in into the US, I'm not saying that the US is doing zero innovation anymore. Okay. It is less, the economy is less driven by innovation, but there is still innovation. Yeah. So there are today, from a venture capital perspective, fantastic companies to invest in that give you 5x, 10x when they graduate and when they move into IPO stage or go public or get sold. So these are, again, fantastic opportunities to look at. But for the US, my recommendation is to do it bottom up and not top down, be very, very, very selective in these investments.
Yeah, so I think my Indian listeners would be very happy with the way that you said, India is fantastic. In fact, I do discuss the Indian markets on the show as well. So I'm sure that your validation would make them really, really happy to keep plowing in. I mean, the Indian retail investor continues to put money in the market anyway. So thank you for that positive take on the country. But I just want to talk about gold for a bit, because I've seen numerous posts of yours about gold, about how you're bullish on gold. I believe you had made it. I mean, it was a public post on LinkedIn, so I can quote it. Do you have 20% of your physical, allocation, your portfolio allocated to physical gold?
Yes.
Yes. So 20% of your portfolio allocated to physical gold. So my question is, now that the rate cutting cycle has begun, obviously, in a more shocking way than we thought, do you think gold will continue for its rally for the rest of the year? And the reason being, the Indian financial media was talking about gold the other day, and Indians love gold. We absolutely love it during festive season. So they were talking, and you have Bank of America that has a price target of 3,000 on gold. JP Morgan has a price target of 2,700. Do you think that with the rate cutting cycle, possible soft landing or any of that sort, do you think gold has still legs to run? Do you think it'll hit these levels?
I do, actually. I do. I mean, I was talking about the 2,700 level, I think 3 months ago on a TV show, and there was a guest in front of me who laughed. There's no way. He was laughing at me for saying 2,700. We had 2,600. Which is 2,600. So, and because I look at the flows, because I look at who's buying, and because I look at the turnover. Look at the Shanghai turnover of gold. I posted on it as well on LinkedIn, where I show the activity in Shanghai regarding turnover of gold. I mean, the graph just goes like this, horizontally, and suddenly for 2024, literally goes through the roof, the activity of gold. Okay. We are in a tense world today, geopolitically.
Yes.
Okay. I'm not talking economics. I'm not talking finance. Here I'm talking politics. The world is very, very tense.
Very true.
I know I'm not 80 years old, but I read a lot of history. From what I can see, we have never had so much correlation among geopolitical events around the world as much as we have today.
Yes. Yeah.
Middle East, North Korea, South Korea,
Mm-hmm.
Taiwan, China,
Mm-hmm.
okay, Ukraine, Russia. All of these events are linked. Okay, so the world today is divided.
Yes.
You have all of these and all of these.
Yeah.
So one domino that falls, all of it will fall.
Yeah.
China will enter Taiwan,
Yeah.
North Korea will enter South Korea, and we will have regional wars all over the place.
Yeah.
In the Middle East today, what is happening is actually very, very serious and could expand substantially.
Of course. Yeah.
Okay? Supply lines for oil could be disrupted and will have to take a very, very long way. So oil is another investment, the black gold as it's called.
Yeah.
So today, to hedge, to solidify your portfolio, the best is for gold. Now, for the private individuals, my advice is do not buy gold ETFs. This is not gold. This is not gold. This is paper. Okay, this is paper. It's very easy to buy a small safe. You put it at your home or somewhere safe, and you put your gold in it. Okay, you can rent a safety deposit box in a bank for $200 a year, and then your gold is safe there. Okay, you can buy small gold bars, etc. You don't like that? I have an even better solution for you, where you hit two birds with one stone. You make the wife happy and you invest into gold. Buy jewelry for your wife. Believe me, gold will be very safe with your wife. But as long as you buy good, real gold, not something gold-plated or bad quality. Good, really good gold. This is an investment for your family, for your wife, for your children, for your daughters, for later on.
Dr. Lemand, I think the amount of female listeners on the show would just shoot up after that comment you made about about the statement, and probably the male listeners would be like coming down and we could test the correlation later about it. But no, you make a valid point, and in India it's the festive season now with Diwali coming up and so on. There's a lot of gold buying happening in, and I think part of the reason why the banks raised the targets was there was a massive influx of gold buying that's set to come. I want to come to that final theme now, because you mentioned the black gold, you mentioned you mentioned oil, you mentioned gold. I want to talk about. I'm saying this with as much sarcasm as possible. Your your favorite data is the new oil, so to speak. You know where I'm heading with this. I want to talk about the market's other craze, and which recently seems to be dying down a bit, to be honest with you. And I'm kind of glad it is, because then you can flush out the losers and the ones that winners that come in. And of course, I'm talking about the AI trade. I mean, you recently posted a very interesting graph on LinkedIn, and about NVIDIA CEO Jensen Huang's insider activity, which showed that since the start of July this year, Jensen Huang sold over 4 million shares, worth approximately $500 million. And your reaction to the post was, go ahead and buy the dip that he's selling, in a subtle sarcastic tone, which I absolutely enjoy. So my question is very simple. I'm not going to talk about NVIDIA per se. I'm not going to speak about stock specific. I just want to talk about AI trade, or the AI, sort of the revolution or party, or whatever the media. Yes.
Can I say a very quick phrase on Mr. Jensen? He is still selling every single day. Every single day, 120,000 shares of NVIDIA.
Oh my
every
God.
single day. Please check. Every single day, non-stop since the beginning of summer.
So it's even more now. So since the post has been posted, it's even more. So my question is very simple. Obviously, I'm assuming. I mean, I wouldn't be surprised if you said the AI momentum, AI. Your views on the AI trade is on the short term is negative. Let's put it that way. But what do you think about the long term of the AI revolution? Do you really think? See, the reason I'm asking is you've got potentially more than $1 trillion of potential capex spend by the big four. I'm talking about Meta, Amazon, Microsoft, Alphabet. The analysts have predicted nearly $1 trillion of capex spend just for AI. Is it all going to be worth it? Do you really think that it's all, or is it just hype from a long-term perspective?
As long as there's no product, I don't believe in it. And I go back to year 2000. In year 2000, I was a very young trader, and internet came. Imagine there was no internet, and internet came. You could book your cinema ticket online. It's fantastic. It's disruptive. to have internet, you need routers, right?
Yeah.
You cannot have internet without routers. There is
Yes.
one company that used to produce routers. One. It's called Cisco.
Yes.
So what would you imagine would happen, right? It's the only company that produces routers. This company is going to go to the moon.
Yeah.
So I was buying Cisco. I was buying Microsoft. I was bullying everyone who didn't believe in it.
Yeah.
What happened afterwards?
The bubble.
It burst.
Yeah.
Cisco went to the. Cisco was very profitable back then. Very profitable.
Yeah.
There were many internet companies that were very profitable, but there was no product yet. What we call today the Internet of Things.
Yes.
It didn't exist back then, and this is why all of this internet hype died down afterwards. The same thing is happening with AI today. Okay, let me give you another example. Maybe people my age will remember that when cell phones came to be. There was this fantastic brand called Nokia.
Yes.
If you had a Nokia, I mean, you were the coolest person on earth.
Oh, yes.
It was the best phone on earth. You throw it on the ground, doesn't break. I mean, it was a fantastic phone.
The battery
right?
life used to last for months on end.
Yeah, exactly.
Crazy.
So you think this is it. This is the future. And then 2007, the iPhone came.
Yeah. And that was the end of that.
Yeah. So what we have today, you rightly mentioned, I mean, hundreds of billions of dollars are being spent on data centers, on all of this. But where's the product? Where's the revenue? OpenAI, the biggest product today, makes $3.2 billion a year.
Correct.
This is enough to compensate for all the capex being spent? Out of each 10 companies being invested in who are doing AI, it is estimated that 9 out of the 10 will go out of business. What will happen with this capex going into these companies or this investments, VC investment? They're going to disappear. So this big mass that we see will have to shrink, and a product has to be invented. What we have today, ChatGPT, etc., where you go paste an email, it corrects it for you. This is not AI. This is not artificial intelligence. Okay? This is inference. It's two completely different things. There's nothing intelligent about it. It's inference. And this is what I hope people will read about and understand. There's nothing intelligent. It's fantastic how it corrects mistakes, right? It's fantastic how it solves a math problem. Mostly correct. Mostly correct, not always. And this is why this is not AI. AI is like a calculator. 1 + 1 = 2. It cannot make a math mistake.
Exactly.
Right? So let's go beyond the hype. The AI product is not yet here. It's going to take 5 to 10 years, like any other technology.
But actually, you make a valid point, and it's something that actually, I remember I was looking through Alphabet's earnings call, when CEO Sundar Pichai, he said, I would rather overinvest now rather than underinvest in AI spend because of this long-term potential. Do you think, is it just to tell shareholders, you know what, I mentioned AI, stock price goes up? Is that the thing, or?
Yes, it's all hype. It's all because everyone makes money out of it. It's a cash cow. It's a cash cow. Look at earnings or earning calls. Okay. Leaders of certain companies are using the wording AI just because the stock price goes up afterwards. And I'm sure you read this. Investors have to be smarter than that. Okay. Let me give you a parallel or a segue. Okay. Climate change. The hype around climate change. And okay, fine. Google has announced they are 48% above their carbon targets. So they're polluting 48% more than they should because of the data centers. Did anyone say, oh my God, that's bad? No, right? No. If China announces today, oh, we're now polluting 48% more than we were before because whatever, everyone would start shooting arrows at China, right? But Google, it's okay. It's okay because it's AI, right? So come on. We have to be smarter than that. And let's put our money in a smart way and not be driven by this hype, because it is a hype.
So it's like
I'm not saying the technology is not good and that it will not go somewhere very good for humanity, but not yet.
I mean, it's like internet. Eventually, it evolved. They flushed out the losers, brought in like you said, and finally there was a little bit of innovation that was being made by those companies. So you reckon 5-10 year timeline is when we would know what's possible, isn't it?
Yes, let me give you other examples because listeners have to listen.
Yes,
Metaverse. Remember the metaverse?
yes.
Remember the JPEGs
Yes.
that were sold for fortunes? And
Yes.
I have clients who lost money there. Where is it now? Where's the metaverse?
Yeah.
Where are the JPEGs today?
I mean, Facebook even changed their name to Meta Platforms to reflect that. Yeah.
You see, don't follow the hype. Following the hype will make you lose money. Period.
Yes. Absolutely, absolutely. I think, Dr. Lemand, I think that's a fantastic way to end the show, because following the hype will make you lose money. I would have continued to talk to you for. I could go on for hours with you, but I do know that we're running short of time. Probably we will get you on board again for another show, another episode in the future to discuss more on that. But thank you very much. I really like to tell you that thank you very much. There you go, ladies and gentlemen. Don't follow the hype. You will lose money. That's the parting words of Dr. Ryan Lemand. Please do follow him on LinkedIn. He didn't tell me this to say this on the show. I'm saying it because honestly, I've been following his posts, and trust me, they're very refreshing. They're very insightful, and you get a lot more new insights. That's something that when you the same repetitive rather than the same repetitive things that you read. Dr. Lemand, thank you very much once again. It's an absolute honor for you to have for me to have you on the show on this special episode. There you have it, folks. That's it for the 100th episode. We go back to the standard protocol. You'll be hearing my voice again from 101 onwards. But trust me, we will have Dr. Lemand once again, hopefully in a future episode. So the episode, I really hope you guys have enjoyed this episode. I really hope you guys enjoyed the milestone. I really want to thank you all listeners from the bottom of my heart for following me for these 3 years. And, without the support that you've shown, I don't think the show would have been successful, or the show, I wouldn't have got the motivation to keep doing it. So thank you very much from the bottom of my heart. I will see you next week. Until then, as we say on the show, stay safe and make some money. Don't follow the hype. Thank you so much. Thank you.